So the most noticeable difference is that there are no margin calls. This difference is arrived at by a couple of other key differences. One, that Equity Builder is a principal and interest reducing investment loan, and that the underlying securities must all be managed investments, so managed funds, ETFs, SMAs. The main point there is cash flow management that sit inside a financial plan. So budgeting, cash flow management, and those disciplines aren't upset by short-term market volatility as they may be with a margin loan, where there's a margin call. So as you set your plans, set your cash flows, borrow the money to invest, that can then step out over a 5, 10, 15-year period without the volatility in the asset impacting on the credit product. So there are two. All Equity Builder loans have a P&I requirement, so principal and interest. There's a home loan option, which people would be familiar with. So you pay a similar amount each month, and you have a repayment curve that looks like that. And there's also a straight line method where you pay all of the interest each month plus a nominated fixed principal amount. And so that loan will come down in a straight line, hence the name. All of the underlying securities for these loans need to be managed in inverted commas, so managed funds, exchange traded funds, separately managed accounts. The principle there is we're looking for diversification in the underlying portfolio, which enables us in part to take away the requirement for a margin call. As described, so looking for diversification in the underlying, that coupled with the P&I curve or the P&I requirement means that as a lender, we're able to say that these loans aren't subject to margin call. In terms of budgeting, cash flow, not being upset by short-term volatility in asset prices, it really aligns the credit product, I guess, with the asset. So typically a financial planner will advise a client to invest for 5 to 7 years, longer where necessary. A margin loan can be a fairly short-term credit product in that a margin call is a 24-hour requirement. So all of that cash flow analysis, the budgeting is more robust, we feel, inside Equity Builder because it takes away that short-term credit requirement. I don't think it'll take away from the family home. I think it might cause a few property investors to look at financial assets, as an asset class that they might borrow to invest in. Australians are not shy about borrowing money to buy investment property, and that's almost their default position: pay off the family home, borrow some money, buy another investment property. The credit products that have been available for financial assets, so managed funds, ETFs, thus far have all had a margin call attached to them. So lots of investors might like to buy good quality financial assets, but they don't like the credit product that attaches to it. What we have now with Equity Builder is a very similar to a property mortgage credit product, so you can align the term of the loan to the term of the investment, and that short-term volatility that can impact you in a margin loan won't impact you in Equity Builder.